Alright, let's talk tariffs again. You probably remember when the US slapped tariffs, basically extra taxes, on a whole bunch of imports a few years back. Well, in 2025, those tariffs just got even higher. From countries like China, Europe, and more, these tariffs became a huge part of US's economic strategy. But why are tariffs back in the headlines, and what does it mean for everyone involved today? So here's the background. In 2018, the Trump administration started putting tariffs on hundreds of billions of dollars worth of goods, targeting steel, aluminum, and thousands of products from China. The official goal? To protect American jobs and industries by making imported goods more expensive so US-made products could compete. But of course, it wasn't just about economics. There was a lot of talk about unfair trade practices, intellectual property theft, and even national security. Now, what does all this mean for countries exporting to the US? Well, when the US puts tariffs on, say, Chinese electronics or European cars, those goods become pricier for American buyers. That usually means fewer sales for companies overseas, which can hurt their economies. Exporters sometimes try to absorb the extra cost, but often, they pass it on to US consumers in the form of higher prices. Take China, for example. When tariffs hit Chinese goods, some manufacturers tried shifting their factories to other countries like Vietnam or Mexico to keep selling to the US without those extra taxes. Others just accepted the hit or looked for new markets. But the bottom line? Trade got more complicated, and companies around the world had to rethink their strategies. And here's where things get really interesting for Americans. Higher tariffs can mean higher prices on everything from washing machines to sneakers to electronics. That's because importers pay the tariffs, not foreign governments. So, when companies face extra costs, they often pass them on to shoppers. That leads to inflation. Basically, your dollar doesn't stretch as far at the store. Fast forward to 2025. This year, the US government announced a new round of tariff hikes on key imports, aiming to protect American industries, but also sparking global reactions. With ongoing tensions between the US and China, and a global economy still recovering from recent shocks, supply chains remain tight in 2025. So when tariffs go up, it's like pouring fuel on an already burning fire. For example, look at the price of electric vehicles. In 2025, the US raised tariffs again on Chinese EVs and batteries, aiming to protect American car makers and tech. The result? Fewer affordable EVs for American buyers, higher prices at the dealership, and more pressure on the US auto industry to innovate. But it's not just about the price tag. Tariffs can also hit the value of currencies. Countries facing tough US tariffs might see their currencies weaken as demand for their goods drops. A weaker currency can sometimes help them sell more to other countries, since their exports become cheaper elsewhere. But it can also make imports more expensive at home, which stokes inflation in those countries too. So to sum up, tariffs are a powerful tool, but they're not a free lunch. Exporters get squeezed, US shoppers often pay more, and inflation can climb on both sides of the ocean. As the global economy keeps shifting, tariffs are one more piece in a much bigger puzzle, one that affects your wallet, whether you're buying a car, a phone, or just groceries. That's the story behind the tariffs and why they're still making headlines. Stick around for more breakdowns, because in today's world, every price tag tells a bigger story. Now let's zoom in on something you might not notice until you check your bank account: the value of the US dollar. In 2025, the dollar has slipped compared to other major currencies like the euro, yen, and yuan. But what does that actually mean for you, for US businesses, and for the rest of the world? Picture this. You're standing in front of a currency exchange board at the airport. Suddenly, your dollar buys fewer euros or yen than it did last year. For US consumers, this means imported products, think French cheese, Japanese cars, or even electronics from Korea, just got more expensive. That's because it takes more dollars to buy the same goods, which can push up prices on store shelves and add fuel to inflation. And if you're dreaming of a vacation abroad, flights and hotels overseas will cost you more too. But there's another side to the story. US exporters, companies selling American-made goods to the world, are finding that their products are now cheaper for buyers in Europe or Asia. That can give US farmers, tech companies, and manufacturers a real boost, making American goods more competitive on the global stage. Imagine US-made tractors or software suddenly in higher demand in Brazil or Germany because they're a bargain compared to local options. For consumers in other countries, a weaker dollar means they might snap up more US products, from jeans to software, at lower prices. But it's not all good news. Anything imported from the US, like medical equipment or machinery, can become pricier for them too. So, as the dollar dips, the effects ripple out, raising costs for American shoppers and travelers, but also opening doors for US exporters. For the rest of the world, it's a mix of cheaper American goods and costlier US imports. It's another reminder that when currencies move, everyone feels it. At the cash register, in the factory, and even on your next trip abroad. Thanks for watching. Stay tuned, navigate wealth with Svoboda Finance.